you mentioned, I'm a chartered accountant and consultant based in Tullamore. We've been trading nearly 5 years under my own umbrella as an individual sole trader. My background would be mostly, I trained in Grand Torrington, worked as a chartered accountant with an Irish lady over in Brisbane, and the kind of Northwestern Territories, used to fly in and out there as well. Did that for about 3 years and then came back to Ireland. Didn't know what to do with start up by myself or go under an employee bracket, so just decided to take the plunge and go out and trade as myself. So got a few staff here in Tullamore and a massive span of different businesses, industries like that. I work up in Dublin with some kind of higher level businesses up there, and then back in Tullamore I have doctors, farmers, retail, you name it, we cover it from a bookkeeping, accountancy, tax point of view. So I mightn't have the most technical, I might be the most specialized tax person you meet, but we've a massive range of areas that we cover, and it's just the knowledge base grows and grows as you're out there. And then we partner in. I'd have a lot of contacts still up in Dublin for tax advice and anything extra technical, pensions, whatever it is. I support it through. I kind of partner in with people because my attitude is if I'm not the best in it, I'm not going to advise on it, but I do have the backup and support of different people that we link in with. So that's just kind of a little bit of background on me. Today, I wasn't overly sure if I was dealing with like people that are out trading by themselves already, people that are thinking about it, you know. So I kind of just said I'd take a wide span on trading as a sole trader, limited company, or just simple POE work. I'll take any questions that come along the way. I prefer to answer them as they go if you have anything, because it might be more relevant and easy to answer if there's something specific when we're talking through. But please feel free to shout. It's very informal. It's kind of a chat about business. I'm not one to make things overcomplicated, so I like to keep things, and that's how I kind of pitch myself out there as well. As just like some people can overcomplicate the tax field, the revenue field, whereas my attitude is that we're all business people, we're all clever individuals. Obviously, if you're working, you have knowledge out of the area, and I like to keep things simple, clear, and give people the practical, down-to-earth advice that's needed to trade in current times with revenue, banks, whatever the case is. So that's kind of how I just structured this kind of slideshow that I've presented today, if that's okay. So CPD event, making the jump from POE to POE employment. So that's the route I said we take. So I suppose from my perspective, you usually see people trade in 3 different brackets. You can be a POE employee. Within the POE employee, you come up with, even there's issues within POE employment that arise based on tax credits, pay slips, expenses, redundancy can arise. I suppose the benefit of being a POE employee is that your tax is source. You don't have to worry about this year-end tax bill that might arise. And I suppose the concerns of lining up your work on a continuous basis over a 12-month period, you have the security net, I suppose, of getting your weekly, fortnightly, monthly pay taxed at source. You don't have to worry about revenue 99% of the times, especially with PAYE modernisation. And just a quick background, and that is, once upon a time, employers were kind of responsible for making sure the employees' tax affairs were up to date. And depending on obviously who your payroll person is in your employment, things can go wrong. We're only human, and the odd time employees could be left with a tax bill at the end of the year. And with POE modernisation, which kicked in January 2019, it basically takes the onus off the employer. The employer sends through the employment details, tax credits, tax rates, everything that's attached to your PPS number into the revenue system. Revenue come back and say, this is what you paid on net pay. And it results in consistent pay throughout the year. If you were off sick and weren't being paid for your employer, your tax credits will wash through the next couple of paychecks, and it keeps your pay flowing smoothly throughout the year, rather than being left with an under or overpayment at the end of the year, which I think we all prefer to know where we stand on a weekly, quarterly, monthly basis on your pay slip. So that's your standard employee. I don't know if maybe you're all in an employee bracket. We could chat through this at the end, but main benefit is tax at source. If you were an employee and you had medical expenses, you would look at going onto revenue and submitting a Form 12 that can take into account non-PAYE income up to €5,000. So if you have a small trade on the side, you're kind of testing the waters of self-employment, you don't actually have to register for income tax if you earn less than €5,000 outside the PAYE system in a 12-month period. So it's just anyone that's kind of thinking about it, and that €5,000 is net of expenses. So you earn 10,000, you raise €10,000 of invoices, you've €5,500 of expenses through subscriptions or membership fees or internet costs, travel, whatever the case may be, and that would mean then your net profit is 4,500. You would be under the bracket with revenue to register for income tax. It's just a small kind of, if you are on the moving into self-employment stage, and your income isn't above a certain threshold, you don't fall into the income tax bracket. Now, when you submit, when you go and submit your Form 12, you would obviously owe tax. That tax on that net profit of 4,500 wouldn't be taxed at source, so you would have to deal with revenue on your tax bill on that, but that would actually be deducted through your tax credits. You can allocate into future years. So just so you have a tax bill of €1,000, you can request revenue to spread that out over 2 years for your tax credits. It's a nice cash flow way to step into the self-employed bracket, basically, before you are fully confident or sure on what route you want to go down, or if it's part-time work or just side contract work. It's a kind of gentle easing way into being self-employed. And then obviously then the next step would be, if you earn more than that 5,000 net profit, you need to go and register with revenue for income tax. Really simple process. It's literally you have your PPS number, you turn on an income tax registration attached to your PPS number. So you work with revenue, you could be PAYE and self-employed income tax registered, and you proceed on that basis. You just turn on your income tax registration. You tell revenue, from the 1st of January 2021, I am now earning income outside of the PAYE source in excess of €5,000. And then you're on their radar, basically, for being income tax registered. I'd always recommend then that you register your trading name, just in case. Depends on what you trade as. Like my name is Jane Byrne, and I trade as Jane Byrne Chartered Accountant. So I would register my trading name as Jane Byrne Chartered Accountant with the CRO. Now that's your no more involvement then with the CRO. It's a once-off trading name application. You can register any trading name that you want as a self-employed individual, and you can brand yourself off that or market yourself off that, whatever the case is. And then the other piece of the puzzle, then I would always set up a separate business account aside from your personal account. It's not a requirement, it's just a practical tip. I always encourage that when people are setting up, because down the line, everything is always simple when you're in play, but just God forbid you had a revenue audit in 6 years' time, it's much easier to troll through. So present them with your business account, and everything in that is your business related expenses, your incomes, your outgoings, and then you can obviously just keep your personal stuff completely separate. And you could pay yourself a drawing each week or each month from that business account into your personal account and live off that money then. So I just would always recommend anyone going out on their own set up their business account and operate through that account. With revenue then, if you're self-employed, you're deemed to self-assess yourself, basically. So you're obliged to I suppose, revenue, say you tell us what you earn, your expenses, and you submit that, and we take your word for it that is the truth. And I suppose the onus is on the self-employed individual to declare that income and expenses accurately. You'd find that most of the time revenue will accept that. If they have, I suppose, revenue is probably our best run system or entity in the country, on the basis that they've put huge spend into IT and infrastructure, and they can, if I submit a tax return for 5 archaeologists and one of them has extremely high motor expenses, for example, they will know the fluctuation of what an archaeologist should spend on insurance, travel, IT, and anything that just pops out, anything that just red flags basically, and then that's when you would get. That's basically how the system works. It's all done in stats and assessments and comparisons in the industry and benchmarking across the board. So like 95% of the time, if you do everything legitimately and perfectly, you won't get audited by revenue, but it's just when those figures skew a little bit out of the norm, that's when revenue will hone in, and that's when they'll question your self-assessment. And that's why they deem the term, you get a notice of assessment from revenue, and it's how you self-assessed yourself to revenue, basically. So basically self-employed income, then it's all linked to your PPS number. You register with revenue, open your bank account, and you trade honestly to revenue, I suppose, is the bottom line. The third entity the usual entity that one would trade through would be a company. I suppose a company is a limited liability entity. It's owned by shareholders. You become an employee of your company. You register a new company. It's a new legal entity. You register for corporation tax. You register the entity with a CRO. Must set up a company bank account. That you, as an individual, are not the company. The company is its own entity, and you trade through that entity. And by default, by registering a company, you must register for income tax. Every director of a company must also be income tax registered. It's just one of these disclosure requirements of revenue. So I suppose unlike a sole trade, out of a sole trade, you can draw whatever monies you want once you leave money to pay revenue at the end of the year. Basically, out of a company, it's totally different. The money is not yours. The money is the company's. So if you want to take money out of the company, you either have to have a loan in your favor in the company, or if you take it out through a salary and you tax yourself at source. And you're basically an employee of your company. As you can take a dividend, but like that, there'll be income tax issues on that. And then any profit left in the company at the end of the year is subject to corporation tax. I suppose there's a few reasons why people would trade out of a company. It doesn't, they call it an available corporation. Basically, you are a separate legal entity to your company. If someone comes and sues you in the morning, they're suing the company and not you as an individual, not me as Jane Byrne. They're suing my company or your company, whoever it is. And you just get that protection level that kind of separates you personally, your personal assets, your home, your finances. Now, depending on any issues that might arise in relation to being sued or risks attached to that type of those type of risks, that they may get through that veil of incorporation, but it's a block on protecting you personally and your assets that are not in the company. So it depends on your risks, I suppose, of your industry. I wouldn't know overly what kind of risks archaeologists face in relation to insurance and that, but I'm sure, like us all, there is potentially something out there that you could be just slightly wary of when it comes to dealing with the public. And then the main thing that I find is that people hear stories, they talk to colleagues, friends, people in different industries, and they're like, oh, you should be trading out of a company. My attitude is that everyone should start off as a sole trader and give themselves a couple of months to get used to the business world, get used to dealing with revenue, get used to your submissions for VAT, etc., income tax, paying it, getting on top of making your payments regularly to revenue. So when you transition to a company, I suppose, when you are starting to earn more money than you need to spend on in your day-to-day life. So if your net profit is kind of going up to 50, 60, 70,000, then you need to assess, well, what's my lifestyle costs? Do I want to build a cash reserve in my company for future retirement options, for future investments, depending on what you want? It's at that point I would look at, I would always base it on what do you need to live off, and is that in excess of what you're earning at the moment? And that would be my basic. Now, you can complicate it as much as you want, but that would be my basic transition point or train of thought in that if you don't want to be taxed at the higher rate on all of your income, get yourself into a company and leave your money in the company, and you're taxed at a much lower rate, and you can build cash reserves in that company. Because I suppose at the end of the day, if you go into a company straight away, you still need to draw out your salary. You become an employee of the company, like I said, and your tax is sourced through the POA system, just like you are as if you're working for anybody else. So it's a kind of a, depends on your personal circumstances. It's not a one rule fits all. Everyone's personal circumstances are different. Everyone's spending is different, and everyone should review whether they go into a sole trade or a company based on their personal circumstances and not on what the chit chat out there is. You can't compare yourself to somebody else in their personal situation, their family, whatever it is. So I just to kind of point you in the right direction on transition from sole trade to a company. Comes down to your income, earnings, and your personal circumstances. So just a few tax heads, I suppose you'll encounter. Some of them you'll obviously know already. Some of them you might kind of just be starting to hear about. So just from just did a quick check myself, because I always triple check my VAT rates before I talk to anyone about VAT. But from an archaeologist point of view, there's two VAT rates by the looks of things. Non-physical site work versus physical site work. The standard rate of VAT is deemed 23%. The reduced rate of VAT is deemed 13.5%. So like that, there's obviously different streams of archaeology work that you can be involved in, and then you need to be careful then to make sure that you get your definition right between non-site and physical site work, because your VAT would be different. Your VAT rate would be different, that you are obliged to apply to your invoices that you raise for somebody to pay you for your services. VAT can be a bit of a nightmare, but you can also make it very, very simple if you want. It works on inputs and outputs. You raise an invoice, you apply VAT to that invoice at the rate depending on your site or non-site work. I suppose when I just go back to just this point here, when I reference business bank account, I would always set up two bank accounts for a business, especially if you're going to be VAT registered, one being your business trading account. And I'd also always recommend that everyone sets up a VAT account, because unfortunately we see the money come in, and just for just simplistic purposes, you raise an invoice for €1,000 plus VAT at 23%. You would receive a payment from your person you raise your invoice to for €1,230. That €230 is revenues and must be passed straight on to revenue. And for, like we all do it, the money comes into our account. Like we're like, oh, deal with revenue in a couple. We don't have to pay our VAT until for another 6 weeks. I'll use this money for this source and deal with revenue in 6 weeks' time. Everyone succumbs to that, and for not everyone, but you know, it's so easy to succumb to that. But I would always recommend that you get paid your VAT, you put it into your VAT account. It's not your money. And especially, I don't know, I think kind of like myself, archaeologists mightn't have huge outputs in expenses that attract VAT. So what you charge on VAT on your invoices, I'd say 80–90% of that will actually be due to revenue, because you'd have maybe some VAT on your fuel, some VAT on internet, phone, but like we're not buying, I don't think anyway, correct me if I'm wrong, but I don't think you'd be buying huge supplies. Do your work. Your work is obviously service-based. It's based on your knowledge, your expertise in the industry. So you are the service. You personally are the service. So there's no VAT on you operating. So your VAT outputs or your VAT against that you incur on your expenses would be minimal. So hence the reason to set aside your VAT to revenue and not let that build up and a significant amount every 2 months. That can be complicated if you're trading within the EU, and our Brexit has made it delightfully more painful, but I don't know if that's going to be an issue for my audience today. So it's all manageable. When you go into the EU and non-EU, it is more complicated, but with the right advice, you can make it very straightforward. We touched on POE, the terms USC, PRSI. Everyone has their own personal tax bands and tax credits and like that. Not everyone's tax bands and credits are the same. So if two people are working in the same job and they're comparing their salaries and they should be the same, it depends on your personal circumstances. Someone's partner or spouse could be working from home. They could have an unwell child. There's so many different bands and credits that are allocated to everyone depending on their circumstances, that it's just you can't compare like to like when it comes to tax credits and bands. And it depends on if you or your spouse are earning more or less. You know, there's a variety of factors that will change your tax bands and credits, basically. That's you as an employee. The little schemes, you can get the bike to work scheme, the tax saver public transport scheme, little benefits and perks that we can take out as that reduce your POA tax, basically. I think I've seen a huge increase in the bike to work scheme over the last 12 months, especially. Everyone's getting out on the road. So if you buy a bike for €1,000, you could potentially save 40% plus on that bike by putting it through your tax saver scheme if your employer is operating or providing, and most of them are, because it's no major issue. So your €1,000 bike could, over a 12-month period, actually cost you 600 quid. So just little things like that for POE. For income tax, you're taxed nearly identically to a POA person, except you can allocate expenses incurred for trading against your income earned, and then you get taxed on the same income tax rates, PSI rates, USC rates. Once upon a time, the earned income tax credit was way off par to the POE tax credit. They've eventually, I think in the last 2 budgets, or last 24 months anyway, they brought the tax credits for a POA worker and then a self-employed worker to par.
Jane, can I ask a question?
Absolutely.
Sorry, I am actually based in the UK, so I'm an interloper. Would you mind explaining the acronyms, because they're not familiar to me?
The acronyms of, absolutely. So okay, I'll start from the top on that then, if that's okay.
Brilliant,
so VAT is obviously your value added tax. I think you have a very similar in the UK. So that's that. POE is pay as you earn, I think is the
it's the same.
Yeah, pay as you earn. So you're being taxed at source by your employer on your payslip. And within that, so you got POE tax, it's just an employee tax. You got USC is your universal social charge tax. That varies. A lot of the taxes vary depending on your level of income. So say for USC, the first 13 grand is exempt. The next 5 grand, your universal social charge rate could be 1%, and it builds up as the more you earn through your payroll. PSI is oh god, you know, it's a social insurance tax anyway, basically, that everyone pays at some, unless your earnings are extremely low. You don't pay PSI, but it basically contributes to our social welfare system for maternity, state pensions, and that. So, yeah, I don't know. Are you an employee yourself? Or are you fully self-employed, or?
I run a small consultancy, so we're a limited company.
Perfect. Yeah.
But we are planning on hopefully moving over to Ireland. So.
Yeah. Look, they're all the UK and the Irish tax system are basically built. I think the Irish tax system followed the UK tax system. So the letters might look different, but the same principles are in place, if that makes sense.
Yeah.
But,
and sorry, on the previous slide, you had a CRO incorporation.
Yeah. So the CRO is the company's registration office.
Okay.
So for if you're trading as a limited company in Ireland, revenue under CRO are your reporting entities. You report your profits to revenue, and you submit your accounts to the CRO. You have the customs house, I think. Would that be right?
Yeah.
Yeah, you supply your annual accounts into that system every year.
Company's house, yeah.
Company's house, perfect. Yeah. So yeah, it's the same. Yeah, you have the HMRC, we have revenue, and we've got CRO, and you have the company's house.
Okay, brilliant. Thank you.
For income tax, your USC, PSI, you get your tax bands and credits and like that. Everyone's situation is different. I think it's 34,000 taxed at 20%, and then the excess of 34,000 is taxed at 40% at the moment. That's for a single person, and then it depends on your personal circumstance. If you're married, you can earn up to just under 45,000 at 20%, depending on your spouse's income, and you can share tax bands and tax credits if your spouse doesn't utilize all of their tax bands and credits in a 12-month period. And we also operate in a calendar year, just so you know. So yeah, in the calendar year, if your spouse's income is lower, or vice versa, if your spouse earns more and you earn less, you can play around your tax bands and credits And you can actually do that throughout the year now, which is the benefits of POA modernisation. So rather, you can, if someone goes on sick leave or maternity leave or whatever it is, you can take their tax credits at that point in time and use them off your salary in the middle of June or July, rather than have to wait till the 31st of December to take their unused tax plans and credits back. They have become more easier to manage your cash flows on that basis. Two other tax heads then that you might just come across would be obviously corporation tax if you're trading out of a company. Just a side note that kind of it's not discussed, I suppose, but the 12.5% tax rate is for companies. We all probably know about that through the media, and there's obviously ways and means of paying lower tax rates through, I've seen it through Apple and Google and whatever. But that's the standard trading rate, 12.5%. But if you provide a service in Ireland, and archaeologists are specifically listed on service companies, it's basically one individual, like accountants and archaeologists. You are the service. You're making your money from your knowledge. They actually revenue apply a service company surcharge on income that is driven or based from someone providing a service. And I think it brings it up to about 25%. There's different thresholds. There's marginal relief. Bit of a nightmare, to be honest. To explain, it's fine to calculate, but to explain it, basically they surcharge anyone that works in a service company. Like you'd rarely see doctors in a company because of this surcharge. Accountants, a lot of accountants trade out of sole trades. I have a sole trade and a company for different. You can say for an accountant, the bookkeeping element of my business isn't deemed a service, whereas accountancy advice and tax is the service. So I just literally trade through two entities to keep that division of a service company totally separate, and I don't have to explain to revenue then in the future that 50% of this is and 50% of that is in a service. So you can make things simple for yourself, and that's always my attitude when it comes to dealing with revenue. The less you have to explain, the less questions they ask, that they can ask, if that makes sense, the easier your life would be. You don't have to live in fear of them, as unfortunately many people do in this country for valid reasons as well. But then the last tax that I think that your industry would hit on would be withholding tax. Just from communications with Owen, I think you'd contract a lot to public bodies. So if you're contracting to public bodies, they will stop 20% at source on your invoice. Again, go with €1,000. You raise an invoice of €1,000 to a government or public body. They will pay you €800 of that invoice, and they will pay €200 straight to revenue. And it's just a professional services withholding tax. You're basically prepaying 20% of your invoice into your revenue account as you earn that money. It's a protection mechanism from revenue, so that you can't just at least if you disappear in the morning, 20% of that tax is being paid at source. Rather, if you're a POE worker, you pay 40% of your tax at source. If you're income tax registered and not contracting to any public body, it comes back to the self-assessment thing. And then when it comes to working with a government body, they'll stop 20%. They will issue you with a slip called an F45. I don't know if any of you have come across them, but it basically details who you worked for, the agency you worked for, the date you worked for them, the gross amount in the invoice, the 20% stopped at source, and your net payment of your €800 or whatever you receive 80% of that payment. So that's just another side area of dealing with government's revenue. All of these bodies interlink now as well. Like once upon a time, social welfare didn't communicate with revenue, or their systems didn't cross. Their systems cross now. As I said, it's probably one of the most advanced. If only the health system operated like the revenue and social welfare system, they would be laughing. But there's obvious reasons for that as well. Anyway, a little gripe. Just kind of like that again, dealing with revenue. One of the most important things that you'll probably need if you are self-employed is a tax clearance certificate. It used to be called a tax clearance certificate, and you used to actually get a piece of paperwork from revenue. Now it's called the tax clearance access number. So you actually get a 5 or 6 digit number, and it's separate to your PPS. It's linked to your PPS, but it's a separate number, if that makes sense, and it constantly revenue has a system in the background. It's constantly assessing, are you up to date in your tax affairs? Is there something outstanding? Do you owe money to revenue? If all of the above are in place, you will always be in receipt of tax clearance or tax access number. You might, a lot of, especially with public bodies as well, you will be required to give your, they more than likely will ask for your access number, and you will have to provide that to them, and only at that point, be it in the tendering or even the pay, I'd say you have to tender with a tax clearance number, and you'd have to probably have to be in receipt of a tax clearance number to get paid from them as well. So you'll need it for anything to do with finance, banking, lending institutions, and even as simple as taxing. If you have a commercial car or you want to get commercial tax on your car, you'll have to present a tax clearance number that the county council will check and provide you with commercial tax on your motor vehicle.
Just regarding the tax access number, could it be a case, and I suppose maybe some people have come across this, but there's always that fear of, if they check on a given day, you know, am I up to date this week and possibly not next week?
Yeah.
So does it, you know, how does that work exactly?
Basically, one of my slides going forward is kind of you as your self-employed individual or company or whatever you're trading as, you are obliged to keep your tax affairs up to date at all times with revenues. There's specific dates. Say for income tax, you have a certain date to adhere to. For VAT, you have certain bi-monthly dates to adhere to. If you miss those dates, you're deemed non-compliant in revenue. You can miss the dates, and you can miss, even if you file your VAT return and don't pay it, you're deemed non-compliant. I'll go through how to lose your tax clearance status. So like, you can lose it by having outstanding tax returns, outstanding tax liabilities. If you're VAT registered, there's a form called an RTD. Everyone loses their tax clearance because of these RTD forms. They're called return of trading details. It's basically you have 6 VAT returns to submit a year, and then this RTD summarizes those 6 VAT returns, and it's one of these little kind of over the top. I'm sure they have the me it seems over the top. I'm sure they have the reasons for it, but if you don't file your RTD every 12 months, you can lose your tax clearance cert, or you might get paid out in refunds from your VAT refunds. You know, so there's always ways they push you to be compliant, if that makes sense. They know the importance of the tax clearance cert, so they add more and more filing and requirements and obligations, because the tax clearance cert is becoming more and more important, more now than ever. Like I said, you can't get a loan if you don't have a tax clearance cert. Anything that you want to do, if you're a sole trader, and in relation to finance, you will more than likely be asked for a tax clearance number, because that deems you to be compliant with revenue at that point in time on that date. Like I've had guys go to the county council, I just don't. Anyway, I've had guys go to the county council on a Tuesday, and I've printed out their tax clearance cert on the number on a Monday, and they won't accept that because it's one day later and things can change at any point in time. So
okay,
that answers your question without.
Yeah, no, thank you. Thanks.
not in the way you probably wanted to hear it.
No, thank you.
Yeah, were you going to ask something else?
Sorry, Joan. Yes, we have a company tax clearance certificate in Ireland. Would I also need a personal tax clearance certificate?
It's whatever. The tax clearance is attached to your tax trading number. So your tax trading number revenue will be your PPS number if you're self-employed, or your company registration number if you're trading through a company. So the company must, you as a director of a company, or you as the company must also, the same principles apply for tax clearance, be it you are an LTD company or an income tax sole trader. It's the exact same. You fall into the same loopholes. It's actually a tiny bit more complicated for a company, because if you have got 5 directors of a company, all 5 directors' tax affairs must be up to date personally, as well as the company's tax affairs. So if one director hasn't filed their income taxes correctly, or revenue are disputing it, or they could even have, one of the items I said about is unpaid local property tax in Ireland. If one of those 5 directors hasn't paid their local property tax, the company can actually lose its tax clearance based on that one individual. All the company's tax affairs might be up to date, and the 4 other directors out of the 5 might be, but that one director who hasn't paid their LPT by accident because it didn't process through the system the way they had planned it to, that the company could actually lose their tax clearance on that basis.
Be careful who you choose as directors, presumably.
Yeah, pretty much. Absolutely. And just on that, unpaid local property tax is a big thing, because A lot of the local property tax is on your personal private residence. It's like everything revenue kind of bracketed up based on the value of your house. And if you don't pay your LPT on time, they basically that you can lose your tax clearance. And a lot of the time, what actually happens is someone thinks they had a standing order set up, or they had it set up through their payroll with their last job, and obviously they've left that job and they forgot to update their LPT payment process. You lose your tax clearance and LPT. And between LPTs and outstanding VAT return of trading details, they're probably 75% of the reason people don't have tax clearances. And then the obvious one of not having things filed or paid on time, but just the quirky bits that people forget is LPT and VAT or TDs. And then I suppose just in relation to obtaining your tax clearance, it depends how savvy you are in bookkeeping. I can print out a tax clearance for any of my clients right now using their access number instantly. If you as an individual can also set up with revenue on their ROS system, revenue online services. You can set up your own account. I think everything is linked in through my GovID now at the moment. Go through my account, my inquiries is how you communicate now with revenue. They've decided that they don't want to answer phones anymore, and everything is done through writing basically. So yeah, there's different ways you can have an accountant, or you can do all this yourself if you're competent. So lots of ways of managing your own tax affairs yourself. Tax filing deadlines, just really quickly. Income tax, if you're income tax and not VAT registered, you have once a year submission to revenue, and you pay your preliminary tax as well. And preliminary tax is probably what drives most of my clients mad. So if you set up your business on the 1st of January 2020 and you are submitting your 12-month tax return at the 31st of December, that tax return is due for filing on the 31st of October 2021. So you've got 10 months after the year end to file your income tax return. The very first year, you have to pay 100% of 2020's liability and 100% of 2021's liability based on your 2020 tax bill. So your tax bill is €5,000 on 2020's tax return, basically. The 31st of October, you pay €5,000 plus another €5,000 because they want you to prepay your tax for the year ahead. So your first year of trading will always be just the hardest one to get your head around from a tax perspective, because you're basically paying your tax in advance for next year. But what actually catches people out is, like a lot of businesses, they won't make their money in the first year, but to make them the second and third year, and you kind of constantly, you need to be setting money aside always for your tax bill as you're making money. I'll be setting aside a minimum of 30% in a service business, basically, minimum. And that may not be enough, but with your tax credits, your tax bans, your trading expenses, and at least 30%, and you might also have a lot of 20% withholding tax set aside from any government jobs as well. So rule of thumb for service, I'd probably advise if you earn €1,000, set 30% of that to revenue. If you owe €1,000 and 20% of that was stopped, set aside another 10% of that. So you're always allocating 30% when you're trading as an income tax person. If you're trading as a company, you have your annual submissions to revenue, just like you do as an individual. Just the times change. It depends on your year end. That you, like, as a company, you can pick 31st of December, you can pick 31st of May. It depends what suits when you set your business up, when you start trading, and then when you start making money. You can juggle your year ends around a little bit, depending, especially to start, to suit your tax bill. Like that, preliminary tax is a requirement as well. 100%. There's different ways around preliminary tax. The safest option is 100% of your prior year. You can go 90% of your current year, but you always leave yourself open. Like, you're only forecasting anything. You could land a huge project. You could lose a huge project. You just don't know what's going to happen. So I'd always leave yourself not open to interest and penalties with revenue for underpayment of preliminary tax. If possible, pay 100% of your prior year bill. And that's obviously I'd say 50% of my clients pay their preliminary tax. Some of them then try and start prepaying it as they go and have a good chunk paid off. And then revenue, like last year revenue were doing 2017's underpayment of preliminary tax. So they issued out penalty interest bills for 2017. So they're way behind on issuing their preliminary. You think you get away with it for 12 months. But it's not the case. Only 2017's really I seen issued last year on the interest bills that revenue raised from the underpayment of preliminary tax. So they were 3 years behind catching up with people that didn't pay their preliminary tax correct. And then the VAT filing dates. Most businesses get allocated a bi-monthly VAT filing period, so it works on the odd month. So for January, February, you pay and file that in March. For March, April, you pay and file it in May. So every 2 months in the odd month, you file and pay your VAT to revenue, basically. The annual RTD, it's just something that kind of, it wasn't a requirement once upon a time, and now it is for tax clearance purposes. And then if you're trading within the EU, there's a document called a submission called a VIS. Do not ask me what that means. It's something to do with European submissions. You basically, if you are trading within the EU, you can check if the person that you are providing services to in the EU is VAT registered. If both of you are VAT registered, you don't need to charge VAT on your invoice, basically, to the Spanish country, to the Portuguese country, whatever. But only if you go through this VIES system process. And like that, pre-Brexit, we would have traded with the UK through, everyone would have checked there if the entity in the UK had an active VIS, and that's what's changed. And obviously, that the move out of the EU, now we have to charge VAT on our invoices to the UK, and it gets complicated. That's not a discussion for today. Managing your tax affairs. Like, I'd rant and rave for people, just get organised, get on top of it, and make it part of your weekly, monthly routine, just to stay on top of your tax affairs. Like, I'm my own worst enemy in that respect as well. My tax return will be the last tax return to be filed, usually, in my business. With all the other clients I have, I'll be the last person to file my tax return if I listen to my own advice. But like, it's about you. Okay. So you kind of create a history of revenue. They'll never be your best friends, but you could do certain things that will assist you if you ever need assistance from them or leeway in the future. So if you have a good track record with filings, submissions, payments, and you just hit a wall, someone is unwell, someone dies, and you are just not available for 3 or 4 months. If you have a good history with them, and fingers crossed you get a good person at the end of the phone, like, there is a good chance that they will work with you if you come up front with them, you communicate with them, and if you are known, if revenue see a good history of filings, payments, etc., there's a better chance they'll work with you. So I suppose that's one thing. Receipt Bank is my best friend. Basically a cloud-based app. You can circulate these afterwards, but that it's actually now called Dext. Sorry, it rebranded in the last couple of months. So it's an app on your phone. You have an email account to it, and you can obviously you can log in on your laptop, but basically on your phone, you take a picture of your expense receipt. And I'm a paperless office, so all my banking is online. Obviously, I don't get paper statements. I download them, save them to the cloud. On all my expenses, if I go to the shop and buy the paper for the office, you're going to need €3-4. Like, those are the pieces that you lose because that receipt becomes unreadable after a certain amount of time. Never mind holding on to it. I just snapped this. $12.99 is an investment in your VAT collections of your costs. It will save you like so much hassle if and when you come to revenue. It's all cloud-based. It's up in the cloud. You can pile it all into certain time frames, all your expenses. And if revenue come and ask you, oh, what did that cost of €1,200 plus VAT relate to in November 2017, you can literally just date order it on Receipt Bank and say, there's your receipt, off you go. I just think for the cost of $12.99, and we're all, I don't know, but I guarantee nearly everyone has an app, smart type phone. It's a no-brainer for documenting your expenses. It can read your VAT. It can spit it out in Excel or a PDF. I would have an awful lot of clients on it, and I'd have all their login details, and I can just log in every 2 months and do their VAT from it. I don't get receipts into my office as a result of Receipt Bank, and it's $12.99 a month. 50 receipts a month, and then it goes up to another level of maybe €25 a month. And if over a 3-month period, if you go over those 50 receipts, I just think anyone that's going out in business, the way life is at the moment, we're always on the go, on the move. Snap your receipt, up it goes, throw it in the bin, and you don't have to be worrying about gathering your receipts at the end of for VAT periods, I'd recommend it to anybody that's operating their own business. I suppose business.
Sorry, can I ask on that? Revenue accept a scan like that as a legal?
Well,
Because I mean,
so,
we're archaeologists. We're pretty good with graphics.
yeah. So put it like this. What revenue don't accept is credit card receipts. So they want to see the receipt, the backup of the name of the shop, the VAT on it, the date, the amount, the credit card terminal, the merchant terminal docket. No, they are not a receipt. That is the bottom line, right? You have to have your proper till receipt from the shop or the retail unit or whatever it is. Revenue, basically, you don't post anything to revenue anymore. Everything is scanned. So that receipt is going to be scanned to them anyway. You have already got it scanned in the system, and more than likely that same receipt will verify to a bank transaction on your bank account. You know what I mean? So put it like this. This is how I run my business. I scan everything. Everything is becoming paperless. And revenue actually have their own record data keeping system that it's the same principle as receipt banks. They are promoting this type of behavior out there.
Yeah, thanks. I mean, I was just wondering whether in the case of a severe audit, they would literally accept what is possibly a reasonably low resolution scan and not retaining the hard copy.
Yeah, so the only, to the best of my knowledge now, the only thing that they request original documents for is F45s. So that's your withholding tax slip. You have to hold on to the originals for them, but that's not an expense docket. That's an invoicey type more side of it. And for farmers that want to reclaim VAT through the system, for capital expenditure, they must produce the original VAT receipt, and very simply because they're not VAT registered. Revenue want to see the original document basically of your VAT claim. So they're the only, now off the top of my head, sorry, I'm not saying it's 100%, but for a normal Joe Soaps trading that as we are, this receipt bank system, I have had audits from receipt bank, not Hospital Queries, audits, and like people pull documents out of the sky when it comes to a revenue audit. So I mean, first things first, have your receipt. Like I've had audits where people had paper receipts and it's faded and they're no good. So like at least you have a clean document. There's also like with everything that's going on in IT, like they'll see that it's a legitimate system. Revenue notice receipt bank system. There's a whole, like, if anyone wants to audit the system, they'll see when you scanned it up, you know, and you can link it back to your accounts and different. You can even see sure on the receipt these days, a lot of receipts, the actual last 4 digits of the bank card that the receipt was processed from, which will link back to a personal card, be it your business or a personal card of yours. You know, they're not overly. Some things will slide with revenue, some things won't. This system is working because they're promoting a cloud-based system through their revenue online, their Ross account, their My account, their My Inquiries. Everything is scanned, paperless, and they want as minimal interaction to do with the public as possible, only through these scanned cloud-based services that they're providing for communication. And I just made a comment then earlier, sorry, just business expenses. Just again, I just couldn't recommend more, but just about staying on top. It's so easy to do it every month, so difficult to do it every year. So it takes an hour a month to sort out, just to organize it, gather everything up, folder it off, whatever way you want to do. I'm only recommending Receipt Bank because I know I save a fortune by not losing all these receipts, because they will end up in my car, they'll end up out the window, they'll end up in the bin. I'll get pissed off and send my car to get valid and say clear everything out. You know, if it's on Receipt Bank, it's there, and you can pull up these things instantly on your phone. I'm just such a promoter of cloud-based because it's so accessible, and I think it's the way going forward and manage your affairs, is to have everything on a cloud system for ease of access more than anything else. So just going back, documenting income and expenses monthly. Travel expenses, I'd always recommend that. Like, travel is an area, especially for service type industries, when we don't have a huge amount of costs, we can rack up a lot of travel and mileage. Revenue will think that we're sitting on our desks operating our business, but like, everyone's different. Like me as an accountant, I actually like to get out on the road and go see people an awful lot. even during COVID, we still actually went out and dropped stuff off and just had a quick chat from a distance to keep in touch with everyone. Like where most accountants wouldn't do that. So I keep really detailed travel logs of everything and just calendar stuff, and be able to verify if someone from revenue decides that I'm claiming too much travel expenses. I was like, no, absolutely not. I run my business differently. These are all my travel logs, and that's the end. Once you can prove and back yourself up and be confident in how you've managed your tax affairs, revenue they're out to challenge you, not, do you know what I mean? But if you know your affairs are in order and you are confident that you have done it to the best of your ability for the reasons surrounding your trading circumstances, that's the most important thing. And documentation is key. Once you know, you can go back and say, this is what happened on this day, and this is why this expense is incurred. Now, please, that's my answer. You know, they usually do tend to back off because you have the proof, you have the evidence, and they're not challenging someone that doesn't have these expenses that can be verified in the background. Home office expenses, something that people miss out, especially those extra credits for employees working from home because of COVID, if your employer wasn't reimbursing you, like light and heat, oil, internet, mobile phone expenses when you're working from home. I would never, ever claim mortgage interest, because that has knock-on effects if you ever sell your personal home in the future, because part of your if you sell your home, it's a tax-free transaction basically. But if you've allocated some of your house to a business or a commercial entity, and you say you reclaim 20% of your mortgage interest on your tax returns, 20% of that, the sale of your home, then becomes a taxable transaction rather than 100% being tax-free. So I always recommend never claim an interest deduction on your mortgage for business expenses on your sole trade income. I think we're nearly there. Just kind of a few tips more than anything else. Different types of assessment. You can be a singly assessed individual. You can be separately assessed. If you're married but you don't want your tax affairs to come in, your partner's tax affairs to be brought in, you can go for separate assessment, or like a lot of people just by default go for joint assessment. Joint assessment is much easier when it comes to shared tax bands and credits that may not be utilised. There's no major benefit. Joint assessment, the only major benefit is either keeping your tax affairs completely separate from your partners, or being able to juggle around your tax credits and sharing unutilised bits at the end of the year, if that's the way you're going with it. If you ever do fall into difficulty with revenue, I'd always recommend that you communicate with them. Don't dig your head into the sand. It's never going to go away. I've people that have tax bills from 2004, and they will chase and chase and chase. So my attitude is just stand up, get help with your tax affairs, get someone to engage with revenue behalf. You don't have to deal with it by yourself. They're a complicated crowd to deal with, but if there's ways and means of dealing with them. And there's always this thing, a PPA is something that's become really, really simple to get access to. And if you fall behind and you've just not dealt with your tax affairs, you can get a phased payment application and then move forward, but also be paying off your old tax affairs. I've had these applications that go on, can be spread over 5 years to, now obviously there's an interest charge attached to them, but I'm just saying that there is ways and means. If you fall behind, just take your head out of the sand, go deal with it, get some help from an accountant, and they will sort out back payments on with revenue. So if you are a self-employed individual, mortgage applications can become a little bit more difficult. They'll often ask for 3-year trading accounts, tax clearance certificates. So it's just more so to keep in mind. Mortgage applications especially become a little bit more difficult if you're income tax registered. And there is, depending on your bank manager and what bank you're dealing with, you can work around it, but it's just people don't always are aware of that when they go self-employed. And PRSI contributions, you can voluntarily contribute to the PRSI system if your income levels are low. I would always recommend everyone meets the PRSI contribution per year. It's 500 quid is the €500 is the minimum contribution you make, and it gives you a book of stamps for that year, for PRSI contributions for that year, and then it gives you access in the future to pensions, maternity, job seekers, whatever it is. But state pensions is the most important thing, because there's a certain day, the social welfare have a calculation. You must have 48. It's complicated, but basically, if you were sick or decided not to work for 2 or 3 years in your life, from 18 to 66, that can actually knock off 20 or 30 quid a week off your pension entitlements. I think it's about 240 odd at the moment. And because you didn't pay that €500 for 12, 13 and 40 into the PRSI contribution system that you can voluntarily contribute to, if you're not making it through yourself, if you're not earning and creating a PRSI liability for yourself through POE or through your income tax or whatever it is, you will lose out. So I'd always recommend everyone keeps their PRSI stamps up to date with social welfare, even if they're not working, at a cost of €500 a year, basically. Protecting your income and your future and your family impact on your tax affairs. So like that, this is what I was saying, sorry, social welfare contributions are extremely important if you're a self-employed individual, because unfortunately when you go out on your own, you don't have the same, you don't get sickness leave the way you might in an employment. You know, you are fending for yourself to a certain degree. You have less entitlements to the social welfare, which is totally unfair, but it is what it is. So you need to always make sure that you are up to date on your PRSI, big thing for self-employed people. I would also highly recommend income protection. Obviously, the earlier that you get into income protection, the younger you are when you get into income protection system, the cheaper it is. It does cost a few bob, but at the end of the day, if you get sick or anything, you know, that is there as your backup. And you can bracket it on different levels of income that you might want to pay off your mortgage, or you'll have mortgage protection anyway, but living expenses outside of your normal day-to-day expenses. Pension contributions, if you have excess cash at the end of the year, pension contributions, if you pay €1,000 into your pension contribution, you save €400 in tax. So it's just a way, if you have extra cash, to reduce and you're obviously contributing towards your future, because I think the pension works out about 13,500 a year at the moment, and I don't know how I'd live off 13,500 a year, but that's what we're expected to in the future when we're at 66, 67 at this stage. And then there's obviously tax relief for medical expenses, dental expenses, third level education in excess of €3,000 per annum per family. But that is where we are today.